Okay, so many of you in the comments are stirring up conversation and debate on whether or not velocity banking is worth your time and efforts of paying your expenses. Now, you may have noticed that velocity banking has become a huge hot topic over the last couple of years, and most people have found this strategy to be tricky to understand what it's really doing. Now, the main question I want to help answer today is, when could velocity banking actually save you money? So, to premise this, I've noticed these lengthy 15 to 20 minute long videos by content creators with whiteboards and lengthy math equations sharing how it can save you money, and I'm not exactly sure if the creators are sharing this complex method for views, clicks, likes, etc. But today I want to break it down for you in a simple, easy to understand terms. Welcome to the Ascend Finance YouTube channel, where we specialize in providing unbiased, complimentary calls and debt calculators to help you know your options to get out of debt cheaper, easier, and faster. Really just for informational purposes, and is not and should not be construed as financial or legal advice. So one option that I find velocity banking that may be able to help with is a HELOC. So as you may know, a HELOC is basically a revolving secured line of credit where a lender agrees to pay a certain amount of money over a fixed period of time, and then the home is used as collateral. So sometimes you have like a draw period for a long time where you can draw from the line of credit, and then you have a certain payback period. But anyway, so let's go over how a HELOC could potentially be used as a tool in velocity banking. So keep in mind, this method may not be effective for everyone. So really, in order for this to mainly be effective, here's a few things that you may need to have. First, equity in your home. Second, credit score needs to probably be in a good or great standing. Third thing is some sort of healthy cash flow, which basically just means that your income is greater than your expenses. Okay, so what can velocity banking help with? So velocity banking could potentially help avoid paying only towards interest in your first several years of paying towards potentially your mortgage. It can also help pay more towards the principal debt. In hindsight, it could potentially help you pay off your mortgage faster. So the longer chunks you pay towards the mortgage, the less interest you may have to pay. But that's only if the velocity banking strategy goes to plan and doesn't put you further into debt. So of course, this may sound like a lot better on paper than the reality of once being in the plan. Okay, so let's dive into how this all works. So I'm a visual learner, and since this is a rather complex strategy, let's use a visual example. So let's say we have someone named Jerry who recently bought his home and it has a value of $100,000. But he has $80,000 left on his mortgage. So that would potentially mean that he has around $20,000 of home equity. So let's say Jerry gets a HELOC for $10,000. Now, when it comes to velocity banking, he'll immediately apply that $10,000 towards the mortgage payment. So now instead of a mortgage, he will be paying towards the HELOC each month versus his mortgage payment. Now, when he receives his paychecks, he'll immediately deposit the full amount towards the HELOC balance, as in a way treating it as a checking account. Now, for all of Jerry's living expenses, he's putting that on his credit card. This includes his groceries, gas, utility bills, etc. Then once a month, he's using the HELOC funds left over to pay his credit card balance once it's due. Okay, so now that we have a grasp of that, what are the pros and cons of doing that? So yeah, that could be potentially help you and maybe help you pay off your mortgage quicker and shortening the term of your whole mortgage. It could potentially help lower your spending towards their interest, so saving money in interest and paying more towards principal. But there may be some things to be aware of and some cons or costs to look at. So let's go through those now. So by having your income go directly towards paying the HELOC and leaving your credit card to take care of the rest could be risky. Now, on paper, yes, it sounds like a great way to pay aggressively towards your mortgage payments and structure in a way that can allow you to still keep up with all of your living expenses. But there may be a few crucial things to consider. First, do you have a rainy day fund in case of emergency comes up? 2, do you have any room to build your savings for other large purchases? 3, do you have the ability to put money away for other investment opportunities? So those are a few things, but here's something to really consider as well. So the APR that you're now paying on your HELOC with the right interest rate, there's a chance it actually could be saving you money. And as I mentioned earlier in this video, some content creators on this topic are overcomplicating their examples with wordy reasoning and complex math equations. But one thing I have noticed that they tend to leave out is the interest you'll have to pay towards the HELOC. So keep in mind that the interest rates are also subject to increase. Do you have enough equity in your home to qualify for a HELOC? So if you're a recent homeowner, chances are you may not be a good qualifier for this strategy. So would you get the same or similar outcome if you did your normal mortgage payments and just regularly paying off your expenses and credit cards as well as your regular mortgage payments? And then with your extra cash flow, you may have this month you can put towards your mortgage? A mortgage can be seen as a good debt when you're putting money towards an investment that can appreciate over the period of time. It may not always be the best decision to put all your money towards paying your mortgage off quicker, especially if you have a low interest rate. It's key to weigh if having money at your disposal is more important than having no other choice but to contribute towards large payments towards your HELOC payment each month. Okay, so ultimately, it's up to you on what route may make work sense for you. Velocity banking may save you money on interest by applying your HELOC directly to your mortgage payments and chipping away at it in much larger chunks. Keep in mind that this plan can take a great deal of self-discipline, so make sure you fully understand the details before diving in. If you found this video helpful or useful in any way, feel free to click that thumbs up button, and we want to continue to make more videos on velocity banking to hopefully simplify the process. We'd love to hear from you in the comments as well if you have any questions or feedback on this process.